Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Monetary Policy and Economic Growth. Monetary policy is a critical tool used by central banks to influence a country's economic growth. Its primary objectives include controlling inflation, managing employment levels, and ensuring overall economic stability. By adjusting the supply of money and the cost of borrowing, central banks can stimulate or cool down economic activity, thereby impacting economic growth. This lesson delves into the mechanisms of monetary policy, its effects on economic growth, and the implementation strategies used by central banks. The fundamental principle behind monetary policy is the manipulation of interest rates and the money supply. Central banks, such as the Federal Reserve in the United States, the European Central Bank, and the Bank of Japan, use these tools to achieve macroeconomic objectives. By lowering interest rates, central banks make borrowing cheaper, encouraging businesses to invest and consumers to spend. Conversely, raising interest rates makes borrowing more expensive, which can help cool down an overheating economy. This delicate balance aims to foster a stable economic environment conducive to sustained growth. One of the primary channels through which monetary policy affects economic growth is through its impact on investment. Lower interest rates reduce the cost of borrowing, making it more attractive for businesses to invest in capital projects. This increased investment leads to higher productivity and ultimately economic growth. For instance, during the financial crisis of 2008, the Federal Reserve significantly lowered interest rates to near zero levels to encourage borrowing and investment, thereby stimulating economic recovery. Monetary policy also influences economic growth through its effect on consumer spending. Lower interest rates reduce the cost of loans for consumers, such as mortgages and car loans, making it more affordable to purchase big-ticket items. Increased consumer spending drives demand for goods and services, which can lead to higher production and employment levels. A notable example is the post-crisis period following the 2008 financial meltdown, where the Federal Reserve's accommodative monetary policy led to a resurgence in consumer spending and economic growth. Another critical aspect of monetary policy is its role in controlling inflation. Inflation, defined as the general increase in prices over time, erodes purchasing power and can have detrimental effects on an economy. Central banks aim to maintain a moderate level of inflation, typically around 2%, to ensure price stability while fostering economic growth. By adjusting interest rates, central banks can influence inflationary pressures. For instance, if inflation is rising too quickly, a central bank may increase interest rates to cool down the economy and reduce spending, thereby bringing inflation under control. Quantitative easing is another tool used by central banks to influence economic growth. QE involves large-scale purchases of financial assets, such as government bonds, to inject liquidity into the economy. This increase in the money supply lowers long-term interest rates, stimulates borrowing and spending, and boosts asset prices, thereby promoting economic growth. The Federal Reserve's QE programs during and after the 2008 financial crisis are prime examples of how this tool can be used to support economic recovery. Despite the effectiveness of monetary policy in influencing economic growth, it is not without limitations. One significant challenge is the time lag between the implementation of policy measures and their impact on the economy. It can take several months or even years for changes in interest rates or the money supply to fully affect economic activity. This lag can make it difficult for central banks to respond swiftly to economic shocks or changes in economic conditions. Moreover, the effectiveness of monetary policy can be constrained by the zero lower bound. When interest rates are already near zero, central banks have limited room to cut rates further to stimulate the economy. This situation was evident during the aftermath of the 2008 financial crisis, when the Federal Reserve had to resort to unconventional measures, such as QE, to provide additional monetary stimulus. The implementation of monetary policy also involves careful consideration of the global economic environment. In an increasingly interconnected world, the actions of one central bank can have significant spillover effects on other economies. For example, changes in interest rates by the Federal Reserve can influence capital flows, exchange rates, and economic activity in other countries. Central banks must therefore coordinate their policies and consider the potential international repercussions of their actions. Monetary policy's impact on economic growth is also influenced by the structural characteristics of an economy. Factors such as the level of financial development, the degree of openness to trade, and the flexibility of labor markets can affect how monetary policy measures translate into economic outcomes. For instance, economies with well-developed financial systems may experience more pronounced effects of interest rate changes on investment and consumption compared to economies with less developed financial sectors. In conclusion, monetary policy is a powerful tool used by central banks to influence economic growth. Through mechanisms such as interest rate adjustments, quantitative easing, and inflation targeting, central banks can stimulate or cool down economic activity to achieve macroeconomic objectives. While monetary policy has proven effective in promoting economic growth, it is not without limitations, including time lags, the zero lower bound, and the need for international coordination. Understanding the complex interplay between monetary policy and economic growth is essential for policymakers and economists to navigate the challenges of managing modern economies. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.